tax quotient. I have the pleasure of presenting this video on Goods and Services Tax or GST. This is the first of the many videos planned to be presented on GST by tax quotient. Before we plunge into GST or the GST story which we have for you today, I have a few points to make. Firstly, this is only an introductory session on GST. It's a chronicle of the GST as to how it was implemented as a story from a broad perspective covering the significant events and facts along its timeline. I won't go into the legal, procedural or finer details of GST in this session. The facts mentioned here are verifiable and practically all of them available in the public domain, and sources have been indicated wherever necessary. Secondly, this is meant for a common person keen to understand GST, how it works and its impact on different sections. However, even those who are familiar with taxation or are engaged in compliance in GST will find value in it. Accordingly, tax jargons, technical words, sections, rules, citations, etc. have been carefully avoided. Thirdly, we have tried to keep this session short. But GST is a very vast subject, and in this particular session, we have many events and facts to be cited. So it's difficult to cut out and make it short without losing some context. So kindly bear with us. Finally, these sessions are educational only. They should not be taken or considered as technical advice and surely not for taking tax decisions. GST is a multi-stage value-added tax on goods and services. Now, what does this mean? A multi-stage VAT is an indirect tax where at every stage in the value-adding chain, two things happen. First, a tax is levied on the output, and second, the taxes on inputs paid up to that stage are refunded. Thus, what really happens is the tax only at that stage is collected and limited to the value addition at that stage. Hence, it is called a value-added tax or VAT.
This slide illustrates how the concept of value-added tax works. It comprises of both a levy and a refund at every stage in the value-added chain. A very small segment of the value-adding chain, comprising of only 3 stages, have been included to keep it simple. Also, the starting value, the tax rate and value additions have been assumed to be 100, 10% and 50 respectively to keep the example simple. The value addition happens between the first and the second stage and again between the second and the third stage. The value therefore moves from 100, which is the original value, to 150 and finally to 200. So, when the tax rate of 10% is applied on each of these stages, the tax payable becomes 10, 15 and 20 respectively at these 3 stages. This is the levy part. Now, we come to the refund part or the credit part. The tax amount of 10 paid at the first stage is refunded by way of credit at the second stage. Thus, the net payable tax at the second stage is 15 minus 10, which is 5. Exactly in the same way, the tax amount of 15 payable at the second stage is refunded at the third stage. Thus, the net tax payable at the third stage is 20 minus 15, which is again 5. So, the overall tax collected is 10 at the first stage, 5 at the second stage and 5 again at the third stage, which totally aggregates to 20. So, this 20 exactly corresponds with the value at the end of the value adding chain, which is 200. This is how the value added tax works.
The concept of a multi-stage value added tax originated in 1955 in France, and since then well over 160 countries have adopted some form of VAT. Most countries have a unitary VAT or a single VAT. But in India, like in Canada and Brazil, we have a dual VAT comprising of central and state taxes. One question that immediately pops up is, why did GST take this long to become a reality in India? The answer is in two parts. Firstly, India already had some form of multi-stage value-added tax on goods at the central and state levels. Second, you can't have goods and services tax when services are not even taxed in the first place. At the central level, there was a pro forma credit scheme under central excise which existed way back in 1962, which allowed credit on raw materials. The pro forma credit scheme was a precursor to modified value-added tax or MODVAT introduced in 1986. But under MODVAT, input credit was allowed only on raw materials and components. No credit was allowed at that time even on capital goods. So, 8 years later, after MODVAT was introduced in 1986, the scheme was extended to cover capital goods as well and allow credit on capital goods. That was in the year 1994. Much later, in April 2000, MODVAT morphed into CEDVAT, which extended to credit on input services as well. Services actually became taxable for the first time only in 1994. That too, there were only 3 services that were included as taxable at that point of time. This was obviously a pilot scheme and it extended to 3 services which were easy to administer. However, service tax proved to be a boon for the revenue. It grew swiftly year after year as new services were added, and finally, at some stage, the taxes were collected on all services except those covered by a negative list, and therefore the negative list concept was introduced. All this happened at the central level. In a similar way, at the state level too, under the sales tax, there was a set-off that was being allowed. Each Indian state had its own law and there was no uniformity in the sales tax between different states. The lack of uniformity extended not only to the law, it extended to the tariff, it extended to the procedures, the forms, and so on and so forth. It was only in April 2005 when all Indian states adopted a uniform state-level VAT law. Having got the CEDVAT for goods and services at the central level and the state VAT on goods in place, the next natural step was to integrate the central and state taxes through a GST. GST simply said integrates the state and central taxes. It simplifies, makes the tax uniform across states, and removes distortion and reduces tax cascading. GST makes the tax amount payable on a particular item uniform across all Indian states. So, GST was in the making for a long time. The first official mention of GST was by the then Finance Minister, Mr. P. Chidambaram, in his budget speech of 2006. That was around a year after all the Indian states had adopted the state-level VAT on sale of goods from 1st April 2005. The Finance Minister said, the country should move towards a national level goods and services tax, GST, that should be shared between the centre and the states. I propose that we set April 1st, 2010 as the date for introducing GST. Then in the same speech, he went on to say that he would be making the tax rate for goods and services uniform as an essential and a precursor step for moving into GST. Everyone keenly looked forward to the magic of GST. The FM's plan was to introduce GST from 2010, but it didn't happen as planned. Some states were worried sick about the uncertainties in the new GST regime. The states feared an erosion of their fiscal independence and loss of tax revenue. They resisted GST. A federal Indian constitution authorizes the states to independently raise its own taxes as appearing in the state list. This graphics indicates a pie chart which provides for the breakup of the state's revenues. It will be seen that the main source of revenue for the states is sales tax on goods. The information on the chart is aggregated for all Indian states for the fiscal year 2016-17. That's the same year immediately preceding the year when GST was introduced. This sales tax and central sales tax was the main source of revenue, accounting for almost 58% of the overall revenue for all states. With this dependency, it was obvious GST could not have been introduced without the agreement from all Indian states, especially because of the uncertainty around how GST would impact tax collections. Another bone of contention with some states was the petroleum products. Why? Because at the relevant time, petroleum products yielded around 1/3 of the overall indirect tax revenue for the center and the states. Now the contribution is even more after the increases made in central excise rates and followed by commensurate VAT increases which were automatic. So states in which petroleum refineries were located and were collecting central sales tax or CST on interstate sale of petroleum would lose. This is because CST would go away after GST. It would be the receiving state where the goods are consumed that would get the tax. It was a political tug of war. We don't have to go into that as there is no value to be achieved by doing that. Finally, what happened? Well, GST was introduced, but it was a truncated version excluding 5 main petroleum products, that is, crude oil, natural gas, motor spirit, petrol, high-speed diesel and aviation turbine fuel. Also excluded was alcohol for human consumption. In short, the cascading of taxes continues to the extent that central excise or state VAT continues to operate for these excluded items. Now, GST has a lot more stakeholders than just the Indian states. This includes all kinds of consumers, that is the rich, the middle class and the poor. All of them pay GST whenever they consume goods or services. They bear the ultimate burden of the GST. Their interest was limited to only one thing, that is, the GST should not result in an increase in prices and increase in their tax burden. Then there were various types of suppliers of goods and services who are liable to pay taxes. There were manufacturers, service providers, traders, importers, exporters, e-commerce operators, etc. For them, a simpler and more efficient tax system was welcome. Also, a lower tax meant potential growth opportunities for them. However, on the flip side, GST obviously would lead to some disruptions in the initial stages due to teething problems. It was therefore necessary to demonstrate to the stakeholders that though the initial teething problems may manifest, GST was worthwhile in the long run. GST as a tax reform would reduce tax cascading, simplify indirect taxation, unify the Indian market and stimulate growth. A proper understanding of the benefits of GST would secure a strong buy-in from all the stakeholders. This is where the economists, tax experts, industrialists and industry associations chipped in to not only express this confidence about GST, but they also asserted that GST would lead to direct benefits to the Indian economy, GDP. There were many who said many things, but time constraints compel us to list only a few of them. Many predicted an increase of about 1.5 to 2% of the GDP growth. This is what Godrej Group Chairman Mr. Adi Godrej had to say in August 2016, around a year before GST was implemented. At that time, GST was scheduled to be implemented on 1st April 2006. He said implementation of the GST will lead to a GDP growth increase of about 1.5 to 2 percentage points, which will be excellent for the Indian economy. This is very good for the Indian industry. It will lead to lower prices of goods in India that will lead to higher consumption, demand and production. And it will also lead to much higher collection of revenues by both the central and the state governments. Evasion of indirect taxes will become extremely difficult under the GST regime. Mr. Kanoria, President of ASSOCHAM, the oldest Chamber of Commerce in India, said this about GST in July 2016. He said, GST is a Brahmastra for the country. Actually, we need to have a simple platform to move goods within India than we move goods outside the country. At the India Today conclave, HDFC Chairman Mr. Deepak Parekh in March 2017, before GST was introduced, welcomed it, saying it would boost the Indian economy. Similar sentiments were also expressed by Mr. Narayana Murthy, co-founder of Infosys. The then Finance Secretary, Mr. Hasmukh Adhia, addressing a joint central state GST event, said that GST, when implemented, will boost the GDP by 4 percentage points. Such voices were heard not just from India. A paper titled The Effect of GST on Indian Growth, appearing in the US Federal Reserve site, estimated that GST will add 4.2% to the GDP. It read, furthermore, the model suggests that the GST would lead to a real GDP gains of 4.2% under the baseline assumptions, driven by a surge in manufacturing. Finally, the Prime Minister, Mr. Narendra Modi, described GST as the biggest tax reform ever seen in independent India and also called GST implementation as India's second independence. With all these opinions and conclusions, GST is like something magical which would change a lot of things. All this led to one thing, unanimity that GST was long overdue. Once the potential differences were resolved with the states, a number of steps were taken, which can be seen in the graphic. However, the three major events which are numbered are noteworthy. First, an enabling constitutional amendment bill was passed by both houses of the parliament on 8 August 2016 and thereafter ratified by more than 15 states. The first scheduled date of 1st April 2017, being the start of the financial year, was missed. However, since GST is just a transaction tax, it was not material whether it should be introduced at the start of a financial year or not. It could start at any time. Hence, it was postponed and launched on 1st July 2017. But before that, on 12th April 2017, the Parliament enacted 4 acts, that is the CGST Act, the IGST Act, the UTGST Act and the Compensation Cess Act. The states on their part, that is the state assemblies, passed the SGST Acts by 30th June 2017. All the states did that except for Jammu and Kashmir, which introduced and passed it on 7th July 2017. On 1st July 2017, GST was launched by the President, Mr. Pranab Mukherjee, at the stroke of midnight in a specially arranged gala event in the Central Hall of the Parliament. Thus, India got its GST. Well, all that is history now. Before parting, I wish to mention one point. There have been doubts about whether the government had rushed the GST implementation when it was not fully prepared. Well, the jury is still out on that. However, there are two facts which are relevant here. Only a 1-year window was allowed by the Constitutional Amendment Bill. So therefore, GST had to be introduced under any circumstances by September 2017. It had already been postponed once, that is on 1st April 2017. So there was very little room to maneuver. 1 year after the implementation of GST, the then Finance Secretary, Mr. Hasmukh Adhia, made an admission that technology failed the smooth transition into GST. Reportedly, weeks before the deadline of 1st July 2017, the technology service provider informed the Finance Ministry that GST network won't be ready by then. The government still went ahead and rolled out the GST. Another way to look at this is how many changes were introduced in GST after the GST was implemented and before it settled down. The fact is that on an average, the central government issued one GST notification practically every working day since GST was introduced during the first 18 months. In other words, between 1st July 2017 and 31st December 2018, 446 notifications were issued, and this incidentally covers only the central notifications and circulars and does not take into account the state notifications and circulars and the minutes of the meetings and the press note. While all this gives an idea that there were several changes that were made, it is also obvious that a tax reform of this magnitude, which includes almost all goods and services except petroleum and alcohol for human consumption, and it operates at both the central and state level, it is but natural that it will be complicated. It is but natural we should expect that there will be some teething problems and there will be some implementation disruptions. It's really difficult to make a judgment only based on these facts. With this, I would like to end this session here. Thanks for watching. We will return with more on GST. So, goodbye for now.